Hi, this is Adam Khoo, and I noticed something really interesting that's happening right now. That the world is going a bit crazy because there's over $11 trillion worth of negative yielding bonds, right? In fact, if you look at the bond market in Europe, right, Spain, Sweden, Japan, Germany, France, my God, they've got negative yields, right? In fact, the US market is one of the very few markets with a yield that is still positive in the bond market, right? So what does it mean? Again, what's a bond? For those of you who do not know, a bond is when you lend money to the government, right? So governments issue bonds. If you buy the bond, you're lending money to the government. Now, when you lend money to the government, you want to get an interest rate, right? The interest rate is called the yield, right? So, for example, if you lend money to the U.S. government for 15 years, you lock in your money for 15 years, you get a 2% interest rate per year, which sucks big time, right? Getting 2% a year for 15 years, okay? And if you lend money for 5 years to the US government, you're getting 1.42% return a year, right? So I don't even know why people bother buying bonds and getting 1 to 2% return when you can buy great companies in the stock market and get 20-30% a year, which is what I do in my portfolio. But then again, people are dumb, right? It's okay. But what's even crazier and more dumb to me is that in Europe, yields are negative, which means if you buy bonds from these European governments, you're buying the bond, and not only are you getting an interest rate, but you're getting a negative interest rate. In other words, it's like you're lending money to the government and you're paying the government to take your money for 15 years. It's mad. It's ridiculous. It's crazy, and it's unprecedented. Unprecedented, right? So over $11 trillion of negative yielding bonds. Now, why does this happen? Why is this happening? Okay, first you got to understand, how do you calculate the current yield of a bond or the current interest rate of a bond, right? So current yield is basically the annual coupon payment, the interest that you're getting divided by the bond price. Now, the yield is inversely correlated to the bond price. What does that mean? It means when bond prices rise, your yield or interest rate falls. Make sense? Bond price goes up, yield goes down. Bond price goes down, yield goes up. Now, what is causing these negative yields is that bond prices have been going to the moon. It has been going up like crazy. Now, so why are so many people buying bonds? In fact, buying bonds with 15, 20, 30-year maturities because of intense pessimism and fear in the market. People are freaked out right now, right? People are freaked out that Europe is going through Brexit, could be a hard Brexit. The US is going to a recession. That's what people are saying. China, US has got a trade war. Hong Kong's in turmoil. There's nothing but bad news. So when people are freaked out, they get very emotional. They don't think logically anymore. So when they get emotional, what do? That's right. They do not dare to buy stocks, which they think is risky, which to me, it's ridiculous. If you buy great companies at discounts, that's how you make money. But people don't use their brain, right? So they are freaked out. They put all their money in these long bonds, 20, 30 years, to lock in their money at a fixed interest rate. And because everyone's buying these bonds, guess what? It's causing the bond price to go up. And when bond prices go up, yields drop till they turn negative. So what does it tell me? It tells me that this is not sustainable. It can't sustain for long. Bond prices have gone up 90 degrees in a straight line, parabolic, and it is now in a bubble, right? And again, the bubble's gonna burst. Right now, I wouldn't say it's bursting right now, but it's retracing slightly, but it's gonna have a huge bubble burst in the months to come. Exactly when, I can't tell the future, but recently, bond prices hit a level of resistance, and I saw that resistance. I shorted the bond ETF, made some, well, not a lot, but made some money out of it. I'm gonna show you my portfolio in a while, take a look at it. But there's going to be a bigger bond bubble that's coming. Be careful, it's going to crash. Not just treasury bonds issued by governments, but corporate bonds are also, some of them are negative yielding in the world. In fact, right now, there's something like about 1 trillion of negative yielding corporate bonds. Look at that, it's ridiculous. These are the bond prices going up 90 degrees. Now, I don't care what market, tulip bulbs, dot-com bubble, dot-com stocks, bonds, anything that goes up 90 degrees in a straight line, right? We call that parabolic, is going to crash. Whether it's Bitcoin or whatever goes up 90, it's going to crash, right? So the bond bubble is going to burst and the bond market is going to crash. And so what happened the last time the bond market crashed? Well, I went back and the most recent crash was 1994. This was called the Great Bond Massacre, all right? And the same thing was happening where now at that time yields were not as low as today, right? Interest rates were not as low as today, but it was historically low for that time. Interest rates were 5%, which at the time was really low because interest rates used to be 8 to 9%. If you're old enough, you remember those days, right? So when yields were very low, people were buying bonds and getting complacent, but suddenly, the moment the Federal Reserve increased interest rates slightly, bond yields spiked from 5% to 8%. All right. And I wouldn't say overnight, but very soon, the bond market crashed and bond investors lost $1.5 trillion. Now, when the bond market crashes, how does it affect the stock market? Now, by right, it shouldn't affect the stock market, right? But it does, right? Because people, when they buy bonds, they're highly leveraged. They borrow a lot of money to buy bonds. So when bonds crash, these people have a margin call. People who have bought on leverage a margin call, they can't hold on to the bonds, so they are given a margin call. They are forced to raise cash to pay for the bonds. And so what they tend to do is they'll sell their stocks. They'll sell something else to get the money to finance the loss in their bonds. So there's what we call a liquidity crunch, where liquidity leaves the market, and that causes them to panic and sell stocks as well. And that's why stocks can also go down temporarily during a bond crash. So the last time the bonds crashed, the stock market did go down, but temporarily by about 10%. All right, but by the end of the year, it was at a much higher place. So I wouldn't worry too much about the stock market, but the bond market especially, right? Now, the other thing which is really interesting is that the dividend yield on the S&P 500 companies, that means when you buy companies, you get a dividend, right? The dividend yield is now higher than the US Treasury bond yield. And this is very, very rare. In fact, it only happened twice in the recent past. One time it happened it happened in February 2009, and this was right after the financial crisis. The bottom of the financial crisis, when we started recovering, that's when this happened, right? The dividend yield of S&P 500 companies exceeded US Treasury yields. And it also happened again right after Brexit in July 2016. Now, what happened when this happened during those two instances? It triggered a massive bull run in the markets, right? As you know, February 2009 was the start of the bull run in US equities. And July 2016 also triggered another rally in the US and UK stock markets. So what I'm saying is that traditionally bonds, which are safer, yield more than stocks. But now stocks are yielding more than bonds, which means there's an imbalance which can't be sustained. So only two things has to happen to bring it back to equilibrium. Number one, bond prices must fall and or stock prices must go up. As simple as that. And that's why the moment I saw this happen about a couple of weeks ago, I started to buy more stock of good companies, expecting a rally in the stock market, and I shorted bonds. And that's exactly what I did a couple of weeks ago, and it turned out to be right so far, right? So far since I've done that, you can take a look at the bond market, right? This is the bond ETF, the TLT. So I shorted it at 146. I'm going to show you my portfolio in a while. And since I shorted it, it looks like bonds are going to come back down again. So bonds are coming down in the short term. And you can see the stock market, the S&P 500. That's right. We are now moving up into an all-time high, right? And if you realize, if you've been reading the news 2 weeks ago, everyone was screaming recession, 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 right? And that's when most of the retail investors will sell their stocks in panic and buy bonds which are safer. In fact, I know a lot of people where they told me their private bankers and relationship managers told them to buy bonds 2 weeks ago to sell stocks. And that's really stupid, right? Remember, when people are pessimistic, when you're fearful, you buy stocks and you sell bonds. You do the complete opposite of what people say. Because if you follow the crowd, you follow the mass media, you follow these banks, you're going to get screwed. So people who sold their stocks 2 weeks ago for fear of the recession would now be missing out or the next part of the stock market rally. And if they bought bonds, now they're screwed because bonds are crashing, right? So always remember, never listen to the mainstream news, never blindly listen to people in banks or whatsoever. You have to make your own decision. And the only way to make your own decision is you got to have the knowledge and skills of a great investor and trader. You have to understand fundamental analysis, technical analysis, and combine them for consistent profits. So now let me show you the trade which I took a couple of weeks ago. Let's take a look right now. All right, so seeing how the bond market is really overvalued and in a bit of a bubble, how do I take advantage of it? So the way to take advantage of it is to short the bonds, right? So one way I short the bonds is by using a bond ETF, right? So I'm looking at the bond ETF over here called TLT. This is the 20-year treasury bond ETF. And if you take a look at the monthly candles on a longer time frame, you can see that right now it is actually facing a level of trending resistance over here when it was here at 148.9, where it hit a high and found resistance over there, right? So at that point, I said I was going to short it to take a quick trade as it came down to make some profits and to take profit somewhere up over here. And then I went to a lower time frame, which is, okay, let's look at the weekly candles. And you can see over here again on the weekly candles, you can see the trending resistance over there. And it hit a high of 148.9. So that's when I started shorting it. And then I shorted it. And I've already shorted, by the way. And I'm looking to take profit somewhere at this level of here, taking a nice profit, right? So there are many ways to short it. You could short the ETF directly. You could short using CFDs. Many ways to short it. The way I shorted it was I use put options. I use a put option spread. In fact, you can see it over here. This is the spread which I took. All right. By the way, this is one of my portfolios I run, and most of my portfolios are pretty much the same. It's just that I have separate portfolios for different objectives. And you can see for this portfolio, currently year to date, year to date. Well, this is the last one day. I clicked on it. Wait. All right. There you go. So year to date, you can see the green line is my portfolio and the blue line is the S&P 500. I've mentioned before that my goal is to always be able to beat the S&P 500, every year by at least 2 times, right? As much as possible. So currently the S&P 500 is up about 17% for the year. And my portfolio, you can see, is up almost 36%, 35.6% up for the year. So it's been an up year this year so far. Hopefully I end the year up as well, above the S&P 500. So if you take a look at my portfolio over here, right, you can see this is the trade which I took a couple of days ago. That's TLT, the bond ETF. So notice that I bought the 146 strike put and I sold the 136 strike put because it's a put spread, which means I buy the 146 put and I'm looking to take profit at a 136. So you can see there's a bit of a unrealized profit right now. Profit is still very small, about $700 in profit. I'm looking for a much larger profit as it comes back down again. All right, so this is a put spread which I took when it was at 146. So looking back at the chart, you can see at 146, somewhere about that 146, this is where I shorted it. I bought the 146 put spread. So remember, when you buy a put option, you profit as the price goes down. At the same time, to finance this put, because if I just buy a put by itself, it's going to be expensive, right? To finance the put, I bought the 136 put option. Or rather, sorry, I sold the 136 put option, right? So by selling the 136 put option, I collect a premium, and I use the premium to finance part of the 146 put. So that lowers the cost of my trade. Plus, when it reaches 136 and below, I can take my profit and I take a nice profit over there. So you can see right now the price has come halfway down. So I've made roughly half the profits. So I'm looking for it to come back down a lot more to make my full profit. So that is how essentially I look at the economy, the market situation. I drill down, look at the charts. Now, I never trade based on macroeconomics. I never trade based on news. I use news and macroeconomics. To develop a thesis for where I think an asset is going to go, bonds, stocks, whatsoever. And I then use technical analysis and charts to look at support and resistance, candlestick patterns, to know when to take the trade. I then use an instrument. I could use stocks or CFDs or options to place the trade with a risk-return ratio 1 to 2 or more, which means I don't win all the time, right? In fact, I'm right maybe slightly more than half the time, okay? But when I'm wrong, I lose 1% or 2% of my capital. If I'm right, I make 2 to 4 to 5% of my capital. So as a successful trader, we can't be right all the time. We just need to be right half the time or slightly more than half, and we lose less when we're wrong. We make more than we are right, and that's how we make consistent profits and how we build our wealth through our portfolio. And the idea again is, if you manage your portfolio well, if you take the right trades, you can beat the market every single year, in fact, by quite a large margin. And that's basically what you can learn from learning about options and technical analysis and stock trading as well as investing. So if you like that, like the video and watch more videos coming up. Thank you. May the markets be with you. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.